the winds have changed as far as policies, domestic political policies go, and economic policies. We have yet to find out whether that's a positive or a negative.
Yeah, I think it's interesting too, international assets in particular. It's one of those, if you don't love them at a, say, 14 multiple, you're going to love them at a 20 multiple. And I say that because investors kind of need to see those tailwinds. So to your point, whether it's a currency spurred kind of rotation out of US into non-US assets, I think investors need to see that come to life before they're willing to make that allocation.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC-registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
All right, welcome to episode 14 of our podcast, The Bull of Wall Street. I'm Jimmy Lee, the CEO of the Wealth Consulting Group. I have with me co-host Jim Warden, who's on every one of these, our CIO, and today Paisley Nardini, a special host that comes on once in a while when we have special guests. Paisley is on our investment committee and helps us out a lot from a consulting standpoint. And today we've got Brian McMahon. Brian is vice chair of Thornburg, really a co-founder of Thornburg, manages some portfolios that have had phenomenal performance over many, many years. And CIO, so an investment pro, businessman. One of the things I'm told to ask you is how in the world, and 42 years ago in Santa Fe, New Mexico, did you find your partner, Garrett Thornburg, and start an investment firm? And we'll get there. But I think our team did a little research on you, Brian, and you were with Norwest Bank at some point in your career. So lot of times, we start out the podcast by asking you how you got here. Now, you've been at Thornburg a lot of years. So can you tell us your story of being in this business and the journey from the very beginning to where you're at now?
Yeah, sure. Next month, I'll be 41 years at Thornburg Investment Management. So, we were a virtual startup when I moved from Minneapolis and Norwest Bank, where I had been for almost 5 years, to Santa Fe, basically to start up our own line of mutual funds. And our first one was a laddered maturity municipal bond fund, kind of a bank style laddered maturity municipal bond fund. And that was slow to get off the ground and hard to really ramp up the business from a startup in Santa Fe at a point in time when most money managers were either in New York or California, and a few in Chicago, and pretty much nobody in the Rocky Mountain time zone, let alone Santa Fe. So we had our challenges, but we were able to stay lean and mean while we were growing. And we grew slowly. And what I noticed from the very beginning was if I would talk to 20 financial advisors, 19 of them didn't care at all about a laddered maturity tax-free bond portfolio. But the one that did was generally very successful and had wealthier clients. And so we were able to grow our company initially with really a cult following of higher end financial advisors and their wealthier clients, and maybe to some extent that persists today, because we're independent thinkers and we don't necessarily go for for the largest market segments or the hottest products. But what we do try to do is focus on things that are sensible strategies across market cycles, and then hopefully we execute capably on those sensible strategies. And fashion comes and goes in the investment business, but I think the sensible strategies can persist, and our job is to try to execute, and then to try to keep people informed about what we're doing and how we're adapting to particular environments, because the environment changes, the weather changes. So as I said, we can't control the wind, but we can adjust the sails.
That's awesome. And I remember, so I've been in the business almost 30 years, Brian, as a financial advisor. And I remember Thornburg being known for your muni bonds management, active management. I think your entire assets under management are all actively managed. Is that right?
Yes, that's right. It's about $46 billion today, and it's all active management.
And then the other area of expertise I know that you guys perform very well in is also, I know you run a multi-asset product that has had tremendous performance over the length of, I think, 22 years maybe. So we can get into that later. But I know you're also have a lot of expertise, your firm, in international equity investing. When did that start?
Well, that really started when, as a byproduct of our first equity fund, which was Thornburg Value Fund. And Thornburg Value Fund was a relatively unconstrained equity portfolio focused on intrinsic value. And what we noticed at that time was in some ways similar to what we find today, is that there was a lot of intrinsic value outside the U.S. in the late 1990s. And so we got our value fund up to between 25 and 30% of our assets were outside the U.S. Non-U.S. headquartered companies. Maybe they had a lot of business in the U.S. Maybe they had more business in the U.S. than, say, Coca-Cola does in the U.S., but their headquarters was outside the U.S. So at some point, we decided we can't go any higher than this with a weighting of Thornburg Value Fund in non-U.S. companies. But these valuations are attractive, so let's start an international fund. And so we started an international equity fund, again, focused on intrinsic value in 1998, which was a tough year from a marketing point of view for international equities. We had the Asian debt crisis. We had the dollar very strong. And most advisors and their clients weren't interested at all in the international equity area. But that changed in the early 2000s, and let's say the dollar versus the euro went from about 88 cents would buy a euro to $1.65 to buy 1 euro between 1999 and maybe 2008. I can't remember the exact year or when the dollar troughed, but so at some point in that continuum, people got interested in international investing, and it was probably around 2003 or so. And at that point, we had a 5-year record, and a very good record, with our international equity fund. And so our assets kind of took off in that as that came into fashion.
You know, the three of us were just on an investment committee call, and we were talking about how international started this year outperforming U.S., right? Developed international. So I'm going to turn it over to Paisley. She's got I think if you're from Minnesota, she is too. She's an asset allocation specialist. But Paisley, I want to let you ask Brian about some of those thoughts on international and other things.
Yeah, no, actually, I'm glad you teed me up for that. I was just thinking your comments, Brian, on how at the time when you guys launched international strategies, it was perhaps not in vogue, and that quickly changed. I wonder if we're kind of at that similar inflection point today. I think it's been really difficult, not just for international assets versus, say, domestic, but really any diversifier in a portfolio. And you obviously overseeing the multi-asset space will know this well. It's been a thorn, no pun intended, thorn in many of our sides for the last 10 or 15 years to have anything besides domestic equities and large cap nonetheless. Any thoughts that you have on kind of where we are in that cycle and what's that catalyst besides the obvious, right? Dollar devaluation, perhaps, that's going to help investors see the merits of that diversified international asset within their portfolios?
My guess is it'll mostly be currency.
Yeah.
And people won't know, they won't quantify that it's currency that's making them interested in international. But they'll notice that the returns are getting pretty good in international. And then the fundamental investors will respond to this first kind of increments of increased demand for non-dollar based assets. And they'll do fundamental work and they'll see, wow, these multiples really are cheaper. It doesn't matter what sector you're looking at. Pretty much you can look at staples, at energy, at utilities, at banks, and other financials. They generally are cheaper outside the U.S. than in the U.S. And I think there are reasons for the U.S. to be more expensive, but it's just a matter of degree. How much more expensive? And so I'm not sure whether we're quite at that point yet, Paisley, where the pendulum is going to swing. But I am pretty sure that at some point we will be there, and
Yes.
and it might be in the coming years because we have some kind of unconventional policies going on. As I think back to what happened in the early 2000s, what really seemed to set things off was moving from actually the U.S. was running surpluses at the end of the Clinton administration, which surprised everybody as that was developing. And then we had some pretty material tax cuts in the second Bush Jr. administration, and then we invaded Iraq for the second time with a big military operation, and all of a sudden, voila, we had deficits that were pretty material. So that seemed to set off this period of dollar depreciation. So it was somewhat policies made here at home that seemed to set things off. But whether we're there today or not, I don't know. But what I do know is that we do have the winds have changed as far as policies, domestic political policies go, and economic policies. We have yet to find out whether that's a positive or a negative.
Yeah, I think it's interesting too, international assets in particular. It's one of those, if you don't love them at a, say, 14 multiple, you're going to love them at a 20 multiple. And I say that because investors kind of need to see those tailwinds. So to your point, whether it's a currency spurred kind of rotation out of US into non-US assets, I think investors need to see that come to life before they're willing to make that allocation. So unfortunately, for an investor standpoint, right now the valuations have been screaming cheap for several years, but we've seen firsthand that's not enough to drive that rotation, right? There's reasons why the US maintains higher valuations, more innovation, more productivity. So I do concur with you that it's likely a currency discussion from a flows perspective, more so than the old standby, which is capital market assumptions showing, small cap and international assets have greater return potential over the next 5 to 10 years. It's more than just that valuation. So to be determined. Jim, do you have any thoughts on that as well?
Not really. I mean, I'm just thinking about the dollar. It's been all over the map. It doesn't look like there's any real clear trend. It seems to be more, moving as a result of policies here, policies outside. There's just kind of a mixed bag. It feels like with the dollar.
Yeah, I wonder how much too is just driven by from like an interest rate policy perspective, the U.S. rates being higher, attracting more capital inflows. I don't see that changing in the near term. I mean, obviously, if we have a full-blown recession and rates plummet, that's a different story. But it seems like this kind of dislocation in central bank policy with U.S. rates, remaining higher for longer, as whether it's Canada or certain countries in Europe continue to cut. So I think, I don't know, my take is for the foreseeable, the next, 6 to 12 months easily, there continues to be support for U.S. assets, for U.S. dollar. But to be determined, I guess.
Right. Yeah, here's a number I can give you, a couple numbers I can give you. If you want to look at just asset classes, and these are data from Boston College has a Center for Retirement Research that is very quant oriented. And between the years 2000 and 2007, non-U.S. equities had an average annual return of 8.2% between 2000 and 2007. U.S. equities had an average annual return of 3.0%. So 520 basis point gap in favor of non-U.S. equities over a 7-year period. And my recollection, we were about halfway through that when investors started to notice, oh, look, international's doing better.
Yeah.
So it was really...
You don't love it at 14, you're going to love it at a 20 multiple.
There were really only very few financial advisors who recognized that on the front end and kind of maybe made the value argument. Now, if we get between 2007 and 2014, and since then, U.S. equities have significantly outperformed non-U.S. equities by hundreds of basis points. So that's the kind of thing that we see in the past. And by the way, returns to so-called alternative assets, whether it's private equity, hedge funds, real estate, commodities, have declined significantly since 2014, the last 10 years, relative to what they had done in prior decades. So I know that's something that everybody talks about, and we see investment committees saying, "Oh, we have to put more in alternative assets." So we'll see how that turns out. But so far, at least, it's not giving you stunning results.
Yeah, maybe just some last comments I would have on the topic of like, whether it's international or just diversifying broadly, small caps, et cetera. Like from your perspective, from a multi-asset lens, how much are investors tethered to this recency bias, right? We talk about the lost decade in 2000 to 2008 for U.S. assets, but it's so easy to look over the last 5 years, 10 years, 15 years, and just this strong belief that will persist. And I mean, that's something I think about frequently. And like the 60-40 portfolio, when that was constructed as like the bellwether portfolio for diversification, like we were looking at historical data. Are we making, I don't want to say a mistake, but are we looking in the rear view mirror and trying to extrapolate the last 10 to 15 years, which I think we can argue was a pretty um, extreme time period in history, but a short one nonetheless, that we're really extrapolating to say, like, this is the new normal, right? Interest rates are no longer at zero. And that kind of goes to your last comment on alternative assets in that post GFC era had this headwind of zero rates. So from like a lending and funding perspective, a lot of these alternative diversifiers didn't stand a chance, right? Right when they were all being launched and right when all the back tests looked really good. Look what we would have done for you in the, financial crisis. So I don't know. I kind of feel like in the last 18 to 24 months, we've been kind of developing this inflection point where when in 5 years from now, we'll look back and say like, wow, we missed those signals because we were so tethered to this, this prior 10 to 15 year track record. So from like a multi-asset portfolio perspective, do you have thoughts on that? And I hate to say is the 60-40 dead, but the way that we think about the world and the risks and the volatility and the level of rates today, does it just pose a better opportunity to diversify outside of, large cap equities?
Yeah, I don't know. I think it makes sense to diversify out of large cap equities. And I don't think 60-40 is dead. I think that that kind of diversification, stocks and bonds and cash, makes a lot of sense for most people. I will say this. If I look at the last 40 years of U.S. Fed policy, which is basically my career at Thornburg, Fed funds rate averaged 3.45% over the last 40 years. Now, I'll divide that into two distinct segments. The first 26 of those years, Fed funds averaged 5.55%. So that's between 1982 and 2008. That was the average Fed funds rate, 5.55%. The average PCE inflation was 2.85% over that period. So the real Fed funds rate was positive 2.7% for those 26 years. Okay, I lived through that, and I invested through that. I was a professional investor through all of that. The world did not end with a policy rate of real Fed funds rate of 2.7%. People were getting positive real returns by having cash in a money market fund or in a bank account over that period. So that brings us to 2009 to 2024. And over that 14-year period, the Fed funds rate averaged 1.14%. Inflation was 2.11%. So the negative real Fed funds rate was almost negative 1%, negative 97 basis points for 14 years. And that's what I think about, Paisley, when you say, yeah, we were coming out of a pretty abnormal ZERP environment. Now, when I look at most traders that we talk to, Wall Street firms and salespeople, how old are these people? Well, they're somewhere between 35 and 42 years old. And they started in the business during this period. All they've known until the last year and a half or 2 years was a negative real Fed funds rate. So that's what they think is normal. And that's not what I think is normal. What I think is normal is probably a positive real Fed funds rate, a positive yield on 10-year treasuries. So, and that's what affects pricing for all assets. All assets are based on a so-called risk-free rate, and then some premium for any risk asset over that risk-free rate for your expected return. So if you're looking at a apartment portfolio of apartment buildings at a cap rate of 3 or 3.5, maybe that doesn't look so sweet relative to a 10-year treasury at 4.5. But it looked really sweet compared to a 10-year treasury at 1.15%. which was kind of where we were 3 years ago today.
Yeah.
So, so I think, again, you have to adjust the sails when the wind changes, and the wind has changed a lot here in the last few years.
So I want to ask you, if you don't mind, while we're kind of on this topic. So you got your multi-asset income strategy. You can go anywhere, right? So you can go in stocks, you can go in bonds. I'm guessing it's mostly liquid. You probably can't have some things that are too illiquid, but you can pretty much go anywhere. And you've had a great track record. You've been top 1% year to date, 1 year, 3 year, 5 year, you're top 2%. And even the 10 and 15 year, like 7 to 10, top 7%, top 10%. So given all these changes of the wind, the direction the wind's blowing, what are you liking? What are you not liking with regard to bonds, with regard to stocks? Where are you finding the most value in terms of income producing types of investments? High yield bonds, it seems to be trading at a really, really tight spread. It feels like coupon clipping there. Bank loans maybe, are looking better. CLOs probably looking better, but I'm just curious, kind of like, where are you going? If you can go anywhere, what are like the top 3 to 5 areas that you like?
Yeah, well, on the bond side, we're about 15% bonds in Thornburg Investment Income Builder Fund, which is our multi-asset income producing portfolio that I co-manage and have for 22 years. So we have today about 14.5 billion in that fund. We're sticking pretty close to home in fixed income because the credit spreads are so narrow. So from time to time, there'll be something that comes along either in the primary market or the secondary market that our fixed income PMs like. But it's episodic. So I won't say there's never anything in the last few weeks, but it's not a lot, and they tend to be smaller pieces. So we like kind of treasuries better than we like a lot of credit risk right now. We'll work on rates and liquidity, and if one of two things happens: either the economy steams along and the Fed continues to pressure interest rates, maybe even does an unexpected increase in the Fed funds rate, then I think you'll see bond yields go up generally, and you'll probably see some liquidity come out of the bond market, and more bid wanteds in the secondary market. But what we like right now is pretty nerdy bread and butter businesses that pay dividends and generate cash, the kinds of things that you almost never hear anybody talk about day to day on the investment shows. So telecoms we like kind of all over the world, and we have a big weighting there. We've liked banks and financials for some time. Now, U.S. banks have gotten a lot more expensive. So a bank like J.P. Morgan has gone over the last 7-8 years from trading at a discount to book value to trading at more than 2 times book value, and they've achieved very well. But outside the U.S., you can buy banks that have maybe 7% dividend, 6 to 8% dividend yield, that are trading at 70 to 80% of book value, and have maybe a 12% return on equity. So if you want to think about if I can buy a 12% return on equity at 70% of the value of that equity, my return on equity as an investor is 12 divided by 0.7. So it's 18, let's call it.
Yeah.
Hey, that's pretty good.
Yeah.
With a 7% cash dividend. So, and that would describe, say, a BNP in our portfolio, in investment income builder fund. JP Morgan, great, 18, 19% return on equity, but you pay 2.1 times book value for it. So my return on equity as an equity investor is 19% divided by 2. And my dividend yield, my cash dividend yield is 2.5%
It's a
today.
lot lower. Yeah.
So I leave it up to you, but I'm just describing the kind of math that I'm seeing. And
Yeah.
so what I'm seeing is what I just described. And so it kind of makes sense if my clients, my shareholders, and there are a couple 100,000 of them, in this $14.5 billion product, they want income, and they want income that grows, and they want income that's tax advantaged. By the way, they want qualified dividends. So that's what that's what they're hiring me to do, and they let us know that that they number one appreciate income. And they expect that if the income is growing, that they'll get some capital appreciation along with that. And that's pretty much what we've delivered over the last 22 years. Our dividends grown at a CAGR of, say, 4.5%, and our NAV has grown at a CAGR of just under 4%. So, and you add it all up, and it's about 9% per year for the last 22 years. In a way that may sound not so attention getting to some people, but I can tell you that if you really look at what returns people are really getting over time, it's very, very competitive. And for me personally, I started saving in Thornburg Investment Income Builder when we started it at the end of 2002, and my dividend income is up a lot. I've been reinvesting, and so my I'm still reinvesting. But if I wanted to turn the switch, the dividend yield on my original cost would be way up in the 20s.
So maybe a quick question. Obviously, it's a very competitive industry. You've shown over years that you have consistency and kind of top decile, top quartile performance. What is it about Thornburg's process research team that you think is unique or differentiated? Like, how have you guys been able to deliver this consistent investment objectives for your clients?
I'm not sure exactly, because I've been at Thornburg for 41 years and I haven't been everywhere else. But my sense is we don't have a lot of bureaucracy. What I've seen for my whole career is that people want to put you in a little box. And we have style boxes, and style box investing became very popular in the 1990s, and is still popular. And what I see is real value migrates from sort of one pasture to another. And if you're not constrained in a tight box, but you have an objective that's clearly stated that you're trying to pursue, and you're able to use different tools to accomplish that objective, that are relevant to that objective, I think that can be very, very helpful. So,
so essentially like having that ability to take discretion, be active, be opportunistic. And it's no, slight on passive management, but I think it just shows the power of hiring active management in some of these markets where it requires, boots on the ground or a deep understanding, and then it allows you to, shine a light on those opportunities and take advantage of them.
He's being humble. Brian, your answer should have been, because I'm really good, Paisley. But that
I would
being
have accepted that as well.
Hey, Jim, I do want to have you ask later Brian's view on inflation and rates, but Brian mentioned something a bit ago that I know he's passionate about, and that's investor returns, what the shareholders are actually making or not, right? And I've heard that you talk about this subject a lot. I'm very, very passionate about it because, as we know, the majority of the return variable, how variable it is for different investors is due to their behavior, what they're doing with your funds or other people's funds, right? And it's amazing how so many financial advisors, I think, are so bad at it. We're trying to second guess you guys sometimes. And so anyway, could you talk about that a little bit? Because, for my entire career, Brian, I think any investor out there would be happy to get 9% return. Okay. But for my entire career, every single year, I think it's the ICI and other, product vendors provide the reports on an average investor return, which is always somewhere between like 30 to 40% of what the investments do or the market, right? Can you talk about that? Because I know you're passionate about it.
Well, I have seen for many, many, many years, back when I was managing our bond funds, people loved to buy bonds when yields were low and bond prices were high. And that is exactly the opposite of how they shop for everything else. So for everything else, they like to buy more when the price is down. I've observed that about bonds over my whole career. And I think with respect to stocks, it's somewhat similar. It's hard to lean into the wind. And more with more and more quantitative driven investment strategies and then passive investment strategies laid over top of that, many of which are cap weighted. What you have is money that isn't really thinking about anything other than maybe what's the management fee, but it's not thinking about what's the value of what I'm buying for my low management fee. And we have more and more and more of that. So we've moved well beyond 50% of equity mutual funds being passively managed, and then I would say of the remaining 45 or 42, whatever that percent is, that's so-called actively managed, at least half of that is really not actively managed. It's tied pretty closely to some index, and that's where I think large investment bureaucracies pretty much constrain their portfolio managers. You can own plus or minus 2% weighting in a given sector, and they have all kinds of rules which sound like they make sense for limiting risk, but what they end up doing is driving so-called active execution to passive but at a higher cost, de facto passive but at a higher cost. And so to be really active and to have some room to move around, and maybe if you think rates are going up, you don't want to own any utilities or what have you, then I think it's harder and harder to do that. And maybe as we look in the next 10 years or the next 20 years, there'll be kind of a golden period for good active managers that can really be active and really do the fundamental work. So I have noticed, I meet with a lot of managements. I meet with a lot of managements all over the world at conferences, and sometimes it's in small groups with a few other investors. And what I've noticed is more and more very short-term thinking by by some of these investors that I'm in the same room or at the same table with, along with the CEO of a given company. So I'm interested in what's their 5-year plan and how are we going to do that. And then when I come back and meet with them next year, it's how are we doing on the 5-year plan? Is it changing? And I think that the businesses that we want to own are the ones that have a sensible plan and then are executing sensibly with respect to that plan. And so our turnover is pretty low, but I see less and less of that kind of approach to investing than I used to, say 25 years ago, where there were maybe more good questions in the room 20 years ago or 25 years ago than there are now. So that's just a personal observation.
Yeah, obviously you're a fundamental investor, it sounds like, and doing real research. As far as advisors go, though, are you someone as an investor that believes in getting in and out of the stock market at any given points, or do you think that it's smart to always stay invested and maybe rotate your weightings in different sectors? What's your view on that? Because
I think it's more the latter, and honestly, I think the advisors that I know the best, and I've been lucky to get to know quite a few from coast to coast over the last 40 years, they do a magnificent job for their clients because they keep their clients from executing their kind of worst instincts. And how much value can I add? I can add a certain amount of value, but my experience is that the advisors that set good strategies for their clients, client appropriate, and then keep their clients on those strategies as things go up and down, as politics change, whatever, and make adjustments as needed, but not all that frequent. I think those advisors are worth their weight in gold to their clients, and that's what I've seen over the years. And there are excellent advisors, and those advisors have growing practices and growing number of clients, and then there are some that aren't so good, and they kind of keep having to reinvent themselves. But there are a lot of really good ones out there in a variety of firms. Some you might call stockbrokers, but they're really financial advisors, and some are independents and financial advisors. So I admire a lot of them for the work they do with their clients.
Jim, get into inflationary rates with him, would you? I want to get his view.
Well, before I jump into there, so I'm just curious, but you've been in the business a long time, Brian, and you've seen a lot of changes, with technology, with, new industries and then old industries that are changing. They're like, so how is your investment thesis and the way you look at margin of safety, how has that evolved? Because I'm just thinking, I know some other value managers that they want to stick with a certain thesis, a certain idea, newspapers, for example, railroads, like these things over time, they get disrupted. And how do you build that into your process to adjust? But then at the same time, you've got your margin of safety, and you probably have some dry powder for when there are dislocations, and you can say, I want to add. I know in fixed income, we own your Thornburg strategic income, which has done really, really well. Love what you guys are doing there. And so that seems to be very much looking at disruption as an opportunity to be a liquidity provider. But how have things changed over time, and from what you've seen, and how do you think that they will change in the next 5-10 years?
Well, there's a lot of change. I think just looking at the investment landscape and with equities, what we've been talking about, this huge move to passive investing. So, the big the big caps keep getting bigger. Why? Because there's this avalanche of money that moves into them, and the multiples of them keep going up, and the multiples of others that are sort of left behind because they aren't getting those flows kind of go down. I mentioned in our quarterly conference call, our last quarterly conference call for Thornburg Investment Income Builder, um, our PE ratio, weighted average PE ratio for our equities was 13.8 times. It was something in the high 13s. That was a weighted average PE ratio. I looked back for the same call that we did 10 years earlier, for the fourth quarter of 2014, and it was 14.2 times. So here we have grown our dividend, and the kind of stocks that we own in a market that everybody says is so much more expensive, actually cheaper, and and the forward multiple was just under 11 times. So you go from high 13s to 11. That implies actually pretty good income growth. It won't be that good, but that's consensus analyst expectations. Really interesting income growth expected from the portfolio that we own, and it's priced cheaper than it was 10 years ago on a multiple basis. So
Wow.
I was a little bit surprised by that, actually, looking back. But one thing is, I've been around long enough, I can look back. And, the more things change, the more certain things stay the same. So I'm pretty excited about kind of where the opportunities are today. And they're in some of these basic businesses that people aren't really talking about every day, and that have been left behind a little bit. Now, with respect to given industries, yeah, there's a lot of disruption. What I started to ask myself during the 1990s when the internet came along, and I remember when it came along, and then the whole .com boom in the late 1990s, and I just remember thinking, the way people I know live their life hasn't changed that much in the last 3 years. They kind of eat the same stuff, and they go to the store, and they have a house, and they have kids, and blah blah blah. They go on vacation, but it hasn't. All those fundamentals haven't changed that much, just because the internet came along. It changed a lot of stuff and made a lot of stuff more convenient. And now we have that whole debate going on about AI. And how much is AI going to change a given client's life? Maybe a little bit. Maybe it'll help them research their vacation better. But it's not really going to change that much in what they eat, what they buy, where they go on vacation, and where they live. It's not going to change that much. So it will disrupt some industries. I think the industry that I'm most focused on really fundamental disruption is actually energy. And there, of course, like if I was on the board of Exxon or Shell, which I'm not, but I do stay in touch with managements. How do they make an investment decision for something that's not going to deliver the first hydrocarbons until 8 years from now? And it's a multi-billion-dollar investment. And what's the appetite going to be for those hydrocarbons in the year 2040, which is only 15 years from now? And so between year 9 and year 29, what's the price going to be that I'm going to get? And is it going to be good? Is it going to be bad? What's my cash going to be? And so these are difficult things, and I can see kind of some fundamental disruption there that's out there.
Yeah.
But so far, consumption of oil globally is growing by more than 1 million barrels a year. It's up to 104 million barrels. So starting when it was about 97, 98 million barrels, people said oil is dead. And it just keeps living, actually. So, and actually keeps growing. So I want to be really aware of disruption, but you can overdo it a little bit. And how people live their life, if you want to peel it back to that, it actually doesn't fundamentally change that quickly. My monthly budget isn't that much different today than it was 5 years ago, and probably yours isn't either. So
except for the price of eggs.
Yeah.
So there's your inflation. Jimmy wanted me to ask about inflation and rates. What do you think? We're going to have higher inflation? We're going to have lower inflation? Disruption can be good, but what do you think about that?
Yeah. Well, it's 3 right now. That's the latest CPI report. And if I want to again go back 30 years, the average inflation rate was 2.5 over that period. The Fed's target is, as I think everybody knows, is 2. So, and the CPI was in a very tight range, plus or minus a little bit from 2% between 2010 and 2020. So the fact that it's 3 in January, 3% year over year, and by the way, some other indicators of inflation, like say a trimmed mean CPI, which a couple of the Feds calculate that clear out the outliers on either end, is also over 3. So it's above average. It's above the Fed's target. And what we know is that it's mostly driven by services, and services is 70% of the CPI basket, 70% of what we spend our money on. So, and what drives services? What drives services is mostly wage rates. So, so what's going to happen to wages? And I'm not sure what's going to happen to wages, but it doesn't look like they're going down a whole lot. And so there's more job openings today. There's a JOLTS survey, job openings, more job openings today than there are people claiming unemployment today. Most of my career, there were a lot more people, millions more, applying for unemployment benefits than there were job openings. So while that gap has closed a bit over the last year and a half, it's still, this is unusual in my experience to have more job openings than people claiming unemployment benefits. And the other thing I'll say about services is when I look back, so today there's 159 million workers out there. 10 years ago, it was 139 million workers out there in the United States. So between 2014 and 2024, the non-farm payrolls count has grown by 20 million workers. So how has that happened? And a big source of supply to feed that 20 million, I'll guess at least 12 million, is immigrants. And so we've had a huge supply that's grown. In fact, if you want to peel it way back, the population of the United States back at the end of the last century, 12/31/99, it was 282 million people. It's now 340 million people, 58 million people in 24 years. That hasn't happened anywhere else. 58 million people is almost the population of France, the population of Italy, that the United States has given birth to these whole countries in 24 years. So that to me is the most exceptional aspect of what people call American exceptionalism. Nobody else has had that. And so we've had population growth, we've had workforce growth, we've got more people paying into Social Security. And then to come back to inflation, is it possibly inflationary when we have more job openings than we have people claiming unemployment benefits to have immigration cut off and even send back some of these people who are currently in the workforce? I leave that up to you, but I won't be surprised if we have persistent upward pressure on wages, and particularly kind of more manual labor kind of wages and service industry wages. What's going on in the back of the restaurant, or cleaning buildings, or construction, for that matter. So I won't be surprised if there's upward pressure on wages in those segments. But we'll have to see. Maybe robots can do all this stuff. Probably not, but maybe.
Yeah. Well, Jimmy said he wants a robot on one of the other podcasts.
Well, I listen to a lot of podcasts, and one of the ones I listened to, I saw a demonstration of these robots you can buy for about $20,000 today. And so I'm very not concerned. I'm very curious as to how the financial advisor industry might change due to AI, robots. I mean, we've seen robo-advisor programs come and go. Actually, some of them have some decent AUM. But, so that's a topic for later. But one of the things I wanted to ask you about is just kind of, there's not too many people that we're going to talk to that are founders of mutual fund companies, asset management firms, real ones. And, being an entrepreneur and an investment person, Brian, what can you share with us about that and what you learned about business over time? And obviously the asset management business is continuing to really innovate with ETFs. I think you guys are going to come out with ETFs soon. So what can you share with us about being a founder, being somebody at the very beginning and going through all these years of experience? What's the wisdom in that?
Yeah, I guess my learning is it's really hard, and it was hard. It was important for us to be kind of lean and mean in those early years, and the early years is 10, 12, 15 years in our case. So that was it was hard. It was hard to break in. It still is hard to break in. But that's the bad news. The good news is it's a great country, and we have a lot of diverse people, diverse tastes, and we have people that are kind of looking for independence. And there are people that don't want the mass market, whatever it is, whether it's a quick serve restaurant or whatever. So it's a fantastic journey to try to do something and try and do it as well as you can, and communicate what we're trying to do, and very satisfying to have it work and to actually make a living. And so I'm kind of outdoorsy. I'm very outdoorsy, and I do better in Santa Fe than, say, I might have done in New York City or Chicago. because I can walk out my front door and go up a 9,000-foot mountain and be back home in 2 hours. So that's kind of been an important thing for me personally, and maybe for some of my colleagues who kind of feel the same way.
How did you meet Garrett?
Well, we met Garrett. We were both he was at Bear Stearns in public finance and was doing investment banking. And he's from Minnesota, so he would come out to the Midwest, and he's just kind of one of the tribe of Midwesterners, upper Midwesterners, and was rustling up deals. And that was the early 1980s, time of great change, because what happened was Paul Volcker decided to control the supply of money and let the price go where it may. He made that decision in October of 1979 and announced, "Yeah, we're gonna try to beat inflation by controlling the supply of money." And when he did that, Fed funds went from mid-single digits to close to 20%, and so did the prime rate. And at the same time, you had deregulation of deposit rates. From the Depression until the late 1970s, the rates that banks were allowed to pay on deposits were regulated. And that's how money market funds kind of came into being, was when you had inflation in the 1970s and all banks could pay on deposits was 3%, and maybe savings and loans could pay 1/8% more than that. Then money started to kind of find its way out of that regulated channel into these money market funds. And it took a few years, like the better part of a decade, for Congress and regulators to notice that and say, "Oh my gosh, we've got to let these banks compete." And so they deregulated deposit rates. So all of that change happening in the 1980s made it a really, let's say, a ripe environment for disruption of traditional financial intermediation. And Garrett was really interested in that, and I was really interested in that because I could see these bankers, not only at Northwest Bank Corporation in the upper Midwest of the United States, but all over, people that I was dealing with that were really having trouble with that change. I don't know. I was in my early mid-20s. I thought it was super exciting. And I just had a lot of ideas, and Garrett had a lot of ideas. And so he ended up breaking off from Bear Stearns and starting up a tax-exempt money market fund as a joint venture with a New York firm, because Bear Stearns didn't want to pay, they didn't want client deposits to be swept into a money market fund with a 50 basis point management fee when they were making huge spread by paying a few percent on client idle deposits and then investing it at the Fed funds rate. So they were making more than 10% spread on client funds. So Garrett left, starts up this JV for a money market fund that was white labeled by other people, called Daily Tax-Free Income Fund. And that was not a Thornburg fund, but it was a sub-advised fund by Thornburg. And I worked with him all through that.
Wow.
But from the outside, from my position as a corporate finance guy at Norwest Bank in Minneapolis, and he asked me to come down to Santa Fe and join him. And at first, for more than a year, I just said no. I don't like Phoenix. I've been to Phoenix. My best friend went to college there, and my younger brother went to college there. I thought Santa Fe was Phoenix, and after about a year or more, he convinced me to come down and visit. And I found out there was snow and there were mountains and you could ski and in northern New Mexico. And then I just decided, yeah, okay, let's go take a flyer and start up a mutual fund operation. And I guess it was crazy. It was kind of crazy. Not smart, actually, but you know, when you're 28, you can be a little crazy, and we just adapted and again stayed lean and mean for a lot of years, and maybe most importantly, we just kind of delivered what we said we were trying to do, and that's the biggest thing, I think, is if you can just deliver, whatever your business is, if you can deliver what the client thinks they want to buy, then you have a shot at keeping them, and then you have a shot at maybe getting other new clients. And so that's been the journey that we've been on for 40 years, is just to hang our shingle out there and then try to deliver. And it's a big challenge even today.
That's amazing. Thanks for sharing that story. That's and congratulations on your success and taking that risk so long ago. Here's Three's company too. Come and dance on our floor. Take a step that is new.